we are going to unravel the post-Fed rally, market insights, and sentiment analysis. Hello, everyone. This is Shilpa Raidas, and I welcome Jay Vora for our yet another midweek with Indiacharts. Welcome, Jay.
Thank you. How are you doing?
I'm doing very good, Jay. I hope you're doing fine.
Fine. All good. Thanks.
Wonderful. So apologies to our audience because due to some engagements, we couldn't have the midweek yesterday and we are recording it today. So let us quickly begin. Jay, the market rallied hard after the Fed policy meeting. What has changed?
Yeah. So one actually important change from after the Fed meet was that, they acknowledging that the inflation is coming down, and then, there can be a case of a rate cut going in the next year. Earlier, they were very, they were very hard on this thing that if the inflation doesn't come down, they are not going to cut the rates. And in fact, they said that inflation seems to be cooling off, but it is still above their comfort zone, and it is too premature to talk about rate cuts and all. But in the last meet, Fed Powell said that they are open for the rate cuts. But over here, the only thing there where it seems to be a bit of a disconnect is that market is expecting probably 4 to 5 rate cuts next year. But Fed has, I think, indicated of 2 or 3 rate cuts, and that's where the disconnect is. And in fact, after the Fed meet happened, the next day there was some other Fed, I think Fed Williams or so. He came out and he said that it is too premature to even think of a rate cut. We think that we are getting towards that inflation target, but we still need to see some more cooling off, because he said that data can go haywire very quickly, and before the inflation is back. So that's why we want to make sure that inflation uh, is gone completely out of the system, and that's when we'll start thinking of a rate cut. So that was kind of a diverging view that we got, because Fed Powell admitted that they are looking for rate cut, but the other Fed said that that's not necessarily the case. And that's why there was some knee jerk sort of reaction that we saw during the week last week. But everything lasted, I think, just during the day. But in fact, the intraday sell off that was happening due to that statement, that again got bought, and the market kept rallying higher until yesterday, basically, where we saw a sharp decline. But yes, broadly, I think the undertone is kind of that we are in a Goldilocks scenario where the inflation is now coming into control, and growth is also not weakening as such. And that is what is market kicked about, basically. And we have seen a very good rally in the past 1 week or so. And yes, that's it.
Okay, that brings us clarity. Thank you so much. I have kind of a long question for you here next, Jay. So we saw a sharp correction in the US and Indian indices, and are the markets overstretched here? And was this sharp decline the start of a correction that can last for a few weeks, or yesterday's correction was just a knee-jerk reaction, and the indices should continue to rise higher, or no? What's your take on the dollar index, gold, and silver, Jay?
Right. So I'll quickly share my screen. What has happened yesterday was that we got one, very sharp correction yesterday. Apart from that, we were broadly, all the indices were broadly inching higher. And if you see the RSI over here, so basically, see what is happening is that in Indian indices and in US indices, we have a similar case where on the lower time frame, that is the daily chart, RSI is in overbought zone. Okay. RSI in overbought zone usually lead to some sort of knee-jerk sort of reaction, and that is what we have got so far. Okay. Now there is no evidence to say as such that things are reversing. Okay. The only thing that may keep it has come back towards its previous all-time high. So I think S&P 500 has still not hit a all-time high, but I think Dow Jones index has hit a new all-time high. Yes. So it has hit a all-time high over there. So that is what, that might be some point of bother to the people. It has come back towards the previous high and it is selling off. Then should there be a concern or no? But I think even I check the volume PCR, it does tell us that there is still some more room left over there for that ratio to go down. And if that ratio goes down, that is actually bullish for the market, and that means the market can rise higher. See, in this case, the only red flag I think I would say is that if we get a negative weekly close, okay, that means if after tomorrow's trading session, if we get a negative weekly close, so then there might be some point of bother. Okay, and then we need to see that, uh, are we getting a reversal on the daily chart or no? Because this negative weekly close would happen at the upper band, right? So that may lead to some sort of interim high, at least until that high is not taken out. So supposingly, imagine that if we get a negative weekly close, then on the daily chart, averages will become extremely important. In which case, the first average, which is the 20-day average, that is the orange line. If that breaks, then it will open an downside possibility up to the 40-day exponential average. And that's about it. I mean, that is what we'll think initially. It is only when the 40-day exponential breaks, that's where you'll start thinking that, are we heading into a larger correction, or basically how deep the correction can be. That we'll evaluate only when it comes to this point, where the blue line gets taken out on the downside. Otherwise, as of now, it seems to be okay. I mean, it was overbought and there was a strong rally that we had seen, and that is what is getting corrected now. I don't know like how to interpret this, but the ones who are bulls, they would say that that there is a massive intermarket divergence between the small and the mid caps. I mean the small caps and the S&P 500 index. So as you can see over here, if you see the Russell index, I mean, it is well below the previous peak, right? But S&P 500 is around the previous peak now. So the bulls will say that, it has been a good base formation. And now eventually Russell should also pick up on the upside. And that's where the real opportunity would be. Okay. But bears would be saying that, S&P has gone up so much and it has still not done anything. In fact, if the support level breaks, then this is most vulnerable index and it can further go down. So I don't know. I mean, I honestly don't know, which way will it go. We need to see how things unfold. But yes, definitely this is like a band for the Russell index. Okay. And if we see a break above this band and Russell sustaining above that, so then that's where, we'll evaluate if things are changing or no. Because to be honest, there are many things. I mean, there are many global hiccups that we are seeing right now. For example, I mean, Shanghai index, if you see, that has made a new 52-week low. Imagine Nifty and all other indices are making new 52-week high, and Shanghai index is making new 52-week low. So is there a negative surprise that we are getting from there? That is one risk. The other risk basically is yield curve inversion, which we have talked about. So in yield curve inversion, you cannot specifically time the market. Okay, but it's when the yield curve starts getting into the positive terrain. Okay, that's where the risk starts emerging. So right now, if we go by the yield curve of 2 and 10, it is still minus 40. Okay, it is minus 40 bips. So it's only when it gets to that positive part and it starts steepening, so that's where the risk will emerge. So as of now, over there the risk is not there. And yes, obviously, I mean, in the past we have seen that whenever the yield curve has steepened, it has led to some sort of black swan event or a recession in the US. So that is the most feared thing right now. Okay, and that is why we are not able to really conclude what So basically, we don't have a very strong view on what the US indices will do, but all we are watching out for is the technical factors. Okay. So as long as there is no technical reversal, okay, and we are watching a few derivative data as well. So derivative data right now is supporting the bullish momentum. And as long as we don't see any technical any technical indicators showing reversal over there, it seems that US will be just fine for at least few days to few weeks from now. Okay. Now, actually, when we come to the Indian indices, the Indian indices seems to be, in their own zone. I mean, they have been running very hard. There was just a very sharp decline that we had seen in yesterday's trading session. But, equally today, there was a good rebound as well. Now, when we come to the Indian indices, we have a very similar thing going on that, like I said, the RSI was in overbought zone. With this decline, it has come down significantly. But if you see the small mid cap, over there has been a largest dip. Okay, because over there we had seen yesterday almost 3.5% sort of decline. And remember, technically, you will be in momentum as long as you're trading above the 20-day average. Okay. And if you see any of the Indian indices, they are all trading above the 20-day average. So, people may fear that the RSI reading is high, and that's where, it can lead to a deeper correction in the days to come. But, the thing is that RSI can stay higher for longer. Okay. I mean, it can continue to, stay in that overbought zone for a long time. So that's where, you need a price reversal to confirm. So far, in terms of price reversal, the indices haven't closed below the 20-day average. Okay. So yes, until the high is not broken, there is a risk of some sort of correction that can play out. But it's only when the 20-day average gets broken on the downside, that's where, you'll start seeing a risk of a slightly deeper correction where you test the 40-day exponential average. And if that breaks, then again, you'll start thinking that this entire move is complete. So you'll think of retracement and so on. But until and unless I think the 20-day average doesn't get broken on the downside, we are okay. I mean, there will be some correction or some consolidation here and there. But yeah, that's about it. So this I'm talking from a little positional perspective, right? But in the short term, if this low breaks, then yes, we are going to see some correction, right? And then the point of defense will be the 20-day average and so on. And this is what we will watch in all the indices. Like if you see Bank Nifty, it has been trading above the 20-day average. If you see mid cap index, it has been trading above the 20-day average. In fact, today it had opened below the 20-day average, but it rose very sharply today, and it is well above the 20-day average. Then if you see the small cap index, again, similar story. It opened below the 20-day, but it has, retraced very quickly. And it has come back towards above the 20-day average. So in all of these indices, okay, one key thing will be to see what these indices do around the 61.8% retracement level of the entire decline. So small cap has interestingly already tested the 61.8% mark. But when you see the Nifty index, it is still, well below the 61.8% mark. It has retraced 50%. But if 61.8% retracement of this decline gets taken out on the upside, okay, then there is a chance that, maybe Nifty might, again retest the swing high. And then, people may ask that if the high is getting tested, then does it mean, next bigger run or so? So honestly, I don't know. I mean, have to see how things unfold, because at this point of time, the RSI readings and all are so overbought that we don't have any, we actually don't have much conviction to say that this rally can continue to go on without any further correction. In fact, when we see the sentiment data, Okay, there are few concerns now that are that we are seeing. So obviously that we'll highlight in the later part. But yes, when we combine the sentiments and what is happening, on the technical side, it seems like that the upside could be capped in the near term. I mean, even if the high breaks, then it might just end up forming some kind of wedge pattern or a distribution pattern, and then it may come down, right? So this is what we are thinking as of now. But as in when we see some evidence, we'll surely highlight it. So the broader point is that in the short term, the readings were high. That has been cooled off by the sharp decline that we have seen yesterday. Now 61.8% retracement mark, that becomes a key level to watch out for in almost all the indices. Okay, if those indices break past the 61.8% mark, then there is a chance that they can even retest the previous high. And if that is broken decisively, then those are the index where the momentum will be there and the uptrend can continue in the near term. Now, your question about dollar index is actually at a very crucial point. Now, why do I say that is because it has come back towards the lower weekly band. Okay, so does it bounce from here or no? That we need to see. I mean, some people may take top over here and it might look like a 5-wave decline, but actually the top is over here. Okay, then is it A, B, 1, 2, 3, 4, 5, or is it 1, 2? This entire thing is 3, we get a bounce, and then we get a 4 and 5. So we don't have a very clean answer to this right now. I mean, the one thing is for sure that this trend line is broken, right? So there can be a chance that we see some retest and then it goes down. But the only thing is that if the averages gets broken on the upside, then there can be a good chance that the decline which we are seeing in weekly might be complete, and there will be risk of a larger retracement, or maybe we had discussed long back about A, B, C, D, E kind of possibility, that may also come into picture. So we are very watchful about what is happening on the dollar index. Now, I know, many of the people would think that why are we so concerned if the trend line is broken? So that's because when we see the monthly chart, the 40-month average is around 101 month. And so far, it has not broken the 40-month exponential average, right? It's when the 40-month exponential average gets broken decisively, that's where we will have a very good confidence that the pullback is complete indeed, and we are going to see the next leg of decline. But this is a very tricky patch right now that we are seeing, and we will be mindful of that. Now, keeping that in mind, gold and silver is also very interestingly poised. So what has happened is that when we look at the daily RMI, they had given a bullish crossover over here. Okay, I mean basically over here. But what is happening right now is that it is consolidating. Right now, I mean, because this decline has been very sharp in silver and gold, so we need to see the evidence that the averages are holding or no. If the averages hold in this consolidation, then yes, we can see some correction and then it rises higher. Okay, and also the reason being that when you see the very recent rise in gold and silver, they look very much corrective, which means that we are not seeing an impulse move over there. I mean, if you see the hourly chart over here, so everything is overlapping and there is no defined pattern which it is forming. So that's where in the near term, there is a chance that gold may consolidate a bit, within this range. But if the averages hold and it rises higher, and one more thing which I'm watching very closely is how it closes for the month. If we get a negative monthly close, then it may not really be a good sign. But if it manages to post a positive daily close and hold above the daily averages, then it will be viewed positively. So I'm very watchful on that part because, like I said, even dollar index is at a very crucial juncture. And typically gold and silver, they tend to behave opposite of what dollar does. So if the dollar index actually starts rising, which at this point of time it doesn't look like, but that is one of our fear, right? If that happens, then it can pose a risk to gold and silver. Now, if you see silver, it has a similar thing. One thing I'll be watching very closely is how it closes for the month. Right now, it is still meaningfully away from the positive monthly close. I think for that, it has to close about 26 $25.26. Only then it will end up posting a positive daily close, a positive monthly close. If that doesn't happen, then there is a risk over there. And again, in gold, at least we saw a three-wave decline, right? But in silver, this entire decline was one leg. So, the fear will crop up that is this ABC, and then we get a bigger C, in which case we form an ABC in silver. So that is the risk that we are having right now. And, kind of dollar index will help us resolve, which way things will unfold. But yes, in the near term, we'll be very watchful how it behaves around these indices. And if we don't see, a meaningful correction in silver, and it just consolidates over here, then at least we would be prepared for one leg on the upside, and then figure it out, whether it is forming a next leg of impulse, or is this a corrective ABC pullback. So yes, so that's on gold and silver.
That's interesting. I would also like to ask you next, Jay, that do you see any important observations in the sentiment data that is there on strike?
Yes, in fact, over there, a lot of interesting things are happening. So when we actually look at the daily swing, we have highlighted this to the
Yes.
subscribers earlier as well, that, this is a very short-term indicator. Like, it works well from 1 week to 7 day, 1 day to 7 day kind of, time horizon. So today, after, today we opened gap down, right? And we were going down. So at that point of time, the swing reading had gone to 4 kind of level during the day. Now, typically, how much ever back you go, hardly in 1 or 2 instances you will see swing going to that low levels, like 4 kind of levels. Very rarely you will see. Today was one of that day. And actually, if you see the Nifty index, so when you combine this sentiment indicator along with the technical, it works very well, because you can see over here that we had highlighted to the subscribers as well that, this was the gap area. Typically, gap area does act as a support. Okay. So in this case, Nifty took support at the gap area, and the swing reading was very low, which was again indicating that in the short term, the market is very much oversold. And that's where we have seen a bounce. So, is now the only question that we would try to figure out, the answer of this we'll try to figure out in the days to come will be that, see, usually what happens is that swing comes to the oversold zone, and then it again starts a new leg of up move. The index does start a new leg of up move. That happens in a bull market, right? So far, the trend is up, right? So now over here, what we want to see is that, does it happen that we form a 1-2 day kind of pullback, and then again the Nifty index goes down and swing ends up forming a positive divergence? Okay. So that is what something that we'll watch closely. But yes, in the near term, today's low, which the Nifty index has formed, that is of 21,976. That becomes an important low on the downside. If that is protected, then yes, you can see some sideways sort of consolidation, and that may also lead to swing kind of inching higher in the days to come. But yeah, does it break above the high or no? That will be the key thing. Now, from a medium term perspective, okay, this is very important, and people must concentrate on this, is that the FI's positioning, if you see, that has kind of come towards the extreme point. That is the second extreme point it has come to. Okay. And in the past, we have seen that whenever we have seen such readings, it has led to a meaningful correction. Okay. It can be a multi-week sort of correction. And see, earlier what was happening was that if we see the client data, Okay, so at the bottom is the client data, at the top it is the FII data. Okay, so it usually works inversely. I mean, when the clients are very much short on the market, that's where typically the market peaks. Okay, and when the FIIs, their long position are at the highest point, typically that's where the market peak. So over here, see, last week what happened was that FIIs long were somewhere over here. Okay, and the client's positioning was already at the second red line, which means that they were already aggressively short on the index. But now, I mean, if you see the past data, it is not that the this line has gone, I mean, this line has gone much below the second red line. Okay, so it can very well happen, and that seems to be happening right now. But now, given that the FII's positioning has, come towards that 90,000 kind of mark, which is, on the upside, uh, I mean, it works out beautifully well that we typically see profit booking over there. So we need to be, very mindful of the fact how the positioning behave. And also one thing to keep in mind is that we'll have the monthly expiry. So we'll need to see how they are positioned for the new expiry. But yes, at this point of time, it is at an interesting point. And the other thing also is that the 20-day AD ratio, due to the sharp decline yesterday, again, this ratio has declined meaningfully. So we need to see, whether we see a meaningful decline in the days to come, and that would happen only if the Nifty ends up breaking today's low, and if the Nifty ends up, closing below the 20-day average, which I think is somewhere around 20,900 or so. If that gets broken, then that's where the AD ratio may come back towards this red line, and that would mean weakening of breadth. But yeah, I mean that's about it. But when you also see the diffusion indicator, I think, which also works well for the short term. So when you see the RMI buy over here, so this again is declining. Okay, so what may happen is that at some point of time, when it again comes to this red line in the oversold zone, that's where probably new buying opportunities may also start looking favorable, basically from the risk reward point of view. But yes, I mean, if we see the percentage stock with the RMI, which are in buy mode for the Nifty 50, so it is still at 32, and there is still some more room, some more room left. And even if you see the sentiment data, in the average swing, we have a very similar thing over there. Okay, so in fact, today it has touched the 20 mark. So normally, just for people to understand that whenever swing and daily swing, they both get into the oversold zone, that's where typically it becomes a good, sort of pullback period, which we can see in the near term. So we are right now coming to that point, and now it is interesting to see how Nifty behaves. So basically, just to summarize, 61.8% retracement, which is at 21,360 mark, that will be an important upside level. If that breaks on the upside, then there is a good case that maybe the previous high can be retested, and we probably form some kind of ending pattern or something, and only then correct, right?
Okay.
So, but yeah, I mean, just one warning is that just not prematurely short it, because we still don't have any conclusive evidence of that. If you see, the 20-day average has been supported, and so far the higher top higher bottom structure is also not really negated. So we have to be mindful, and we have to wait for today's low to break, because that's where there will be some sort of a real indication of a correction. But the FI's position, FI and client's positioning, that will sort of help you to understand the medium term picture. Okay, so if you're into that FOMO, then you will be little careful, because this might not be a good time to specifically go all in and buy a lot of stocks. In fact, given that they are at an extreme and market some technical factors are also at an extreme. So that's where you'll be, in fact, a little more careful and you'll do your risk management properly. So, we are in that phase where we don't have a clear indication of a bigger correction or a prolonged correction that can set in. But there are few ingredients that are already in place right now. Okay, the only thing that we have to watch very carefully is that, do we get a reversal on the price action? And the reversal on the price action would be a breaking below today's low or closing below the 20-day average. So that would be the reversal point. And that's where, people will then have to manage some risk in the short term.
Okay, wonderful. That was very interesting and very comprehensive, Jay. Thank you so much for that. For those of you who are interested and would like to sign up to Strike, I would leave a link down below. Don't forget you get a free trial. So log into web.strike.money right in today. And while you're at, please do subscribe to our channel, Indiacharts, and leave a bell notification so that every time we have a video up, you are going to get a notification. I will also leave a link down to Strike's YouTube channel and Twitter so that you can get the first-hand information, all that we extract from the platform itself. Thank you very much, Jay, for the great session. I'll see you next week. Yeah, take care. Thank you.